Hello, everybody, and welcome to the American Finance Association panel on central bank digital currencies, CBDC. We're very pleased to have some big giants in the field here to talk about these new developments in DeFi and also in particular about CBDC. We have Darrell Duffie with us from Stanford, David Yermack from NYU, and Hyun Shin from the Bank of International Settlements. And we will hear their perspectives, how the future of money will look like and what role CBDC will play. So before we pass on and have an opening remark of everybody of 10 minutes, I will give some statements initially. And everybody should actually ask questions in the Q&A box. So if you find down the Q&A box, please type down your questions and we'll try to answer them. So let me just start with a few remarks by saying, okay, how the field of money will change. Of course, we have a lot of technical trends going on. Of course, we have smartphones, everybody, and M-Pesa is one of new forms of money. But the more bigger thing is actually digital ledger technology, distributed ledger technology, blockchains, we have Bitcoins, a lot of cryptocurrencies, we have all the tokens coming in, and we have DeFi, smart contracts affecting money as well. There will be programmable money and how programmable money will interact with CBDC and other things. Then there's a whole other development. We have new technologies to exploit big data, artificial intelligence, deep learning, that will change the whole asymmetric information we are familiar with. We move away from adverse selection to inverse selection, where the big platforms have a big informational advantage compared to others. And that changes, very much a banking-centric world we have so far to a platform-centric world of payment. This is very important information in payments data, and that actually changes the whole financial landscape. And how does CBDC interplay with this aspect is very important as well. And then we have Internet of Things payments, we have micropayments. All of these things will change the whole landscape of money, and CBDC is at the center of that. Traditionally, what we have, money essentially, we have multiple issues of money, but we have one form of money. So we have traditionally two-tier system where the government with the central bank is at the center, but private banks issue most of the digital money. In the future, we will have a three-way system where we have the government, the banks, and also the big tech companies. And the BIS has done a lot of work in these dimensions already. And the question is, why do we need CBDC in this environment where, of course, cash is driven out, so citizens move much more to a digital world, so digital platforms. You can't really use cash anymore. That's the only connection between the central bank and the citizens directly. So does the central bank have to introduce its own digital currency? Is it necessary to preserve the monetary sovereignty? Is it a way to get around the zero lower bound? Because for cash, you cannot charge negative interest rates. Can now we charge a negative interest rate on digital currencies? What's about the issues about cybersecurity? And what are the issues? How should we introduce the CBDC? Should it come in a big bang or smoothly? And what are the transition phases? And what are the implications for financial stability? Will the financial banks, will the introduction of CBDC hurt the financial banks? Because then right now they have the power to issue essentially money, to create money. A lot of digital money is created by the banks. Should this be sticking with the banks or removed from the banks through CBDC? Are there synergies between lending and deposit-taking money creation? So we should actually keep it together with the banks or not? Or should we actually give the banks some franchise value by giving them the power to create money in order to have a franchise value so that they don't take so much risk, so they limit excessive risk-taking? What are the issues about bank runs? CBDC is a new safe haven, so there are more bank runs. Or is there some other ways where we can actually channel back the money to the banks such that the bank runs become less likely? So that the debate on the bank run debate as well, we will touch upon that. There are some equivalence theorems under certain conditions. It will not change anything. And on essentially, is CBDC the biggest threat for banks, or is fintech the biggest threat for banks? So a lot of issues coming up. I don't give you any answers, I just raise the issues, and I hope that the speakers and the others will provide the answers going forward. Then there's the whole issue about the uniformity of money, the singleness of money. Right now, we have one money per country or per currency area, and we might have many, many different forms of money. Will we have a network of stable coins? or we will have one official CBDC? Will we allow private issuers to issue some stable coins and later we give them a regulatory stamp so they can actually issue money? And that's one way to go. That might be the way the US is going. Others might go for the official CBDC. What's about programmable money? Is a programmable money an oxymoron in a sense that, you know, you can program money and it might disappear? Does it destroy trust? When suddenly you get some money, you say it's valid for 30 days. After 30 days, it's gone. What's the trust in money? Does it go away with that? Some special purpose money or money which is only for particular digital platforms and it can't be transferred outside of the platforms. And the digital currency areas, you know, what will be these digital currency areas? What will be the boundaries? Will it be more like the boundaries of Facebook, or will it be local physical boundaries like countries? So there are a lot of issues which come up here. And then there's the whole issue related to that about interoperability. You know, what is interoperability? The different concept of interoperability, like how easily can you exchange a token for the digital dollar or some CBDC? Can you accept on a platform can you always pay with a CBDC? Is there something like a digital ledger tender? So a legal tender, so is there a legal tender in digital form? What are the implications of this? Does this impact the competition across the platform? Does it worsen credit provisioning on the platform? So there's a trade-off along these lines. And what's about the portability? If I want to move from one platform to another platform, can I move all my data with it? So there are three different versions of interoperability and how this interact. As you know, I've worked on it with Jonathan Payne on that. So there are a lot of open issues. So I'm just throwing tons of questions on the panel participants here and hope they will all shed lights on that. And with this, I would like to pass it on to Darrell and then to David and then to Hyun. And we have a first round of 10 minutes each. And then we go back and forth and try to answer all these questions and probably even more because the panel members will raise even more questions. And at the end, we hope we come up with more answers than questions. But you know, one objective of this panel is also to throw a lot of questions at you so that you, all of you, can do a lot of exciting research because we really have to figure out a lot of things which policymakers are faced with. And that's one of the purposes of this panel. Thanks again for participating. And let me pass on the word to Darrell, and then after that to David, and then to Hyun. So Darrell, the floor is yours.
Thanks so much, Markus. It's really going to be fun to mix it up with you, David, and Hyun on this really important emerging topic. I want to kick off the discussion by simply asking, why are we talking about this now? Why CBDC is on the tip of everybody's tongue? And in my view, it's because the bank-railed payment system, which has been around since at least the 1600s, has really suffered a market failure. And I want to give you several examples of that. And then I want to come around to whether the best solution is to give up on the bank rail payment system and let it wither and go to a CBDC on the one hand, or try to rejuvenate the bank rail payment system with better regulation, primarily for competition. So let me give you, Markus and team, a few examples of how the bank rail payment system is failing us. The first example that I have is the case of cards. Card-based payments are very expensive for merchants. They represent about 44% of the entire payment stack of revenues for the US payments market. That's huge. It's about triple the level in the European Union, which regulates interchange fees. The problem here is what Jean-Charles Rocher and Jean Tirole called a two-sided market. In this case, it's easy for us to walk into Starbucks. Actually, I was into Pete's Coffee this morning. Tap your card, you get your coffee, you don't pay anything, and you get some rewards, even United Airline miles or cash rewards. And it's no fuss, no muss. It seems great. But of course, the merchants have to pay a very large interchange fees. And that binds everybody to the bank rail payment system at really egregious cost to merchants. The merchants can't afford to say, no, we don't take cards, because then they'll lose a lot of consumers, and the consumers love it. So if you're a fintech payment market entrant, how do you break into that? It's not easy unless you do perhaps what the Europeans have done and regulate down interchange fees and lower the barriers to entry. The US payment stack represents about 2% of US GDP. That's huge. It's much more than in Europe. Second example of a market failure, deposits. The interest rate paid on deposits is minuscule, and that's even when interest rates are well above zero, which they're not right now. Let me take you back to 2019. In April 2019, wholesale risk-free interest rates for overnight deposits were 240 basis points. That was the Fed funds rate at the time. Let me give you a few examples of average US deposit interest rates. I got these from the FDIC's website, and this is the average across the whole US banking system, weighting each bank by the amount of deposits that it has. Remember, the wholesale rate is 240 basis points. The retail rate for savings, it's 10 basis points. For interest checking, 6 basis points. Money market accounts, 19 basis points, or jumbo money market accounts, 29 basis points. So a tiny fraction of what banks are getting when they deposit their money, for example, at the Fed, at the interest rate paid by the Fed on reserves. Now, how do we open up this market to more competition? Well, one way is to do CBDC. Another way would be to allow more competition and entry into the fintech-based payments market. A third example of failure is financial inclusion. According to the FDIC, about 5 million or more households don't have bank accounts, and many more are underbanked. CBDC has been put forward as a way to get bank and payment services to the unbanked. Maybe yes, but let's not be so fast. What do I mean by that? Let's not put the horse before the cart. At this point, we don't have a satisfactory design for a CBDC, one that makes an appropriate trade-off between privacy and the ability of the authorities to check for the legality of payments, and also creates efficiency. There's a lot of promise there, but there's quite a lot of technical work that needs to be done, and it's only just begun. There's a project between the MIT Digital Lab and the Federal Reserve Bank of Boston, but it's only a basic research. A lot more development needs to be done. So yeah, let's get started on developing CBDC technology, but let's not assume that by the time it's ready, we can't have done a better job by regulating the conventional bank rail payments. So let me give you a few examples of how one might improve the payments market in the United States and correct some market failures. First, regulate interchange fees on credit cards. It's not just that they're too high, it's that they make entry difficult. So it's difficult for new firms to enter the payments market. And actually, I'm not really sure why US antitrust laws don't apply in this case, but I'm not a legal expert. It seems to me that if you regulate down interchange fees, then it will be easier for new Silicon Valley type firms to jump into the market and take some market share and cause banks to both lower the fees that they charge to merchants, but also increase the deposit interest rates that they offer to consumers on their deposits. Second, FedNow. Well, FedNow is an instant payment system. What that means is with one app, 24/7, 365 at very, very low cost, you can make payments off your mobile phone, you can make them off the internet, you can avoid the necessity of using the existing expensive bank rail payment system, but it's still bank railed. It's just provided through a Fed app. My concern, however, is that FedNow is being developed as a service by the Fed to the banks. And the banks are then in charge of how to deploy FedNow in their own services to their customers. So if I was a bank acting on behalf of my shareholders, I don't think I would want to use FedNow to cannibalize my very profitable franchises like deposit taking and credit card services. So FedNow needs to be provided in a way that's highly interoperable. It's not restricted to how banks choose to provide it. Another approach is to do what India has done, which is to address the financial inclusion problem by requiring banks to provide very, very basic versions of bank accounts at very, very low costs. And finally, we could regulate the payments market to allow entry. So clarify the regulatory path of entry for fintech payment service providers like stablecoins, provided that they are compliant with AML, CFT, and other legal issues, provided that they protect privacy. Second, allow fintech payment service providers to get accounts at the Fed under suitable regulatory compliance. The promise of CBDC is very high. I'm a big fan of getting started with its development, but again, the technology isn't there yet so as to protect the privacy of Americans and at the same time allow the authorities to check for the legality of payments. China has made great progress in the area of CBDC, but China's governance system makes it a lot easier to achieve a trade-off between privacy and checking the legality of payments. China has simply decided to have all the payment data available in one large government regulatory database. My understanding of Americans, or at least many Americans, I'm a Canadian myself, is that Americans are suspicious of the idea that all payment data would be collected into one data repository managed by the government. The most likely system, as described in much of the available policy research, including the BIS work, is that the US payment data will probably be kept at the level of the payment service provider. It's not yet clear, however, whether that technology will be up to the need for both protecting privacy and the legality of payments and producing financial inclusion. So with that, Markus, let me turn it back to you, and I look forward to the rest of our discussion.
Thanks a lot, Darrell. You raised very important points, in particular points on privacy and your concerns that CBDC might not be ready yet to protect people's privacy, which is essential for the trust in the money we need, because money is all about trust. Of course, you know, there's also privacy with respect to private players. So we have to balance this privacy, you know, with respect to the government and privacy with respect to private players. And I think we can come back to that. And to summarize, you think you're not clear that we have prime time for CBDC yet. I was wondering whether David thinks we're already ready for CBDC in this context, or other forms of digital money, or we also need more time to study and develop the technical background for that. So David, the floor is yours.
Thank you, Markus. And I'm going to share a few slides. I think the past year has really been something of a turning point where the public consensus has begun to tip in favor of most governments very openly experimenting with CBDC. This is a slide published by the BIS, and really for many years, a lot of the skepticism was organized out of Basel. The BIS was, if not holding this back, certainly recommending against these kinds of projects. But what the slide shows is simply the count of political speeches that are either pro or anti-CBDC. The red bars going negative are basically recommendations against, but you see the growth of the blue bars begins very rapidly over the last year or so. And there is some division about whether this should be limited simply to a retail digital coin, digital token of some type that would be used largely for interbank settlements. We already have some versions such as the JPM coin that are beginning to nibble around the edges of this market in the US. But really the more ambitious project is a retail CBDC that would be accessible to all citizens. And I think the success of the Chinese project has made this a much more urgent problem, that we no longer have control of the timeline in a way that people may have thought that we did even a year ago. And the Chinese experiment is a very interesting one. I think even in China, which I'll come back to in a moment, they are reacting to the success of big tech. I think the Chinese government felt it had almost no choice but to retaliate against Alipay and WeChat Pay, which were very rapidly cutting the legs out from under the domestic banking system. I think the same thing can happen in the US and in many other countries, that if we're not looking in the direction of China, we may be doing this as urgently as the Chinese government, perhaps for different reasons and with different goals. But the train has left the station. And I think it's an easy prediction that within 10 years or so, pretty much every major economy in the world will have, if not exclusively digital currency, certainly the alternative or the option. I want to make 3 points about why this is likely to happen. And the first point, I think, in fact, is so important that it sweeps away almost everything else that we're going to talk about for the next 90 minutes. I think negative interest rates are here to stay. And you cannot pay negative interest rates, as Markus said in the introduction. It's a very basic point that if there's physical cash, you can put it under the mattress and get zero. But if the cash is electronic, the government can erase 2% of it every year. And this would no doubt be unpopular, but that's how you do pay negative interest rates. And I think this is going to be an absolute necessity simply because of demographic changes. So the slide you're looking at now is the Fed funds rate. And if you look to the far right, during the global financial crisis about a dozen years ago, you had the so-called zero lower bound, where Bernanke and other central bankers wished to send interest rates down below zero, but were unable to do so, essentially because of the constraints of physical cash. But I think it's really the longer view that is the more interesting one. This is a recent doctoral dissertation by Paul Schmelzing at Harvard University. And it's an extremely impressive achievement in data collection, where he goes back over 7 centuries and documents interest rates. These are like loans from the King of France to the Pope and so forth. But the story being told here is one of gradual decline in the cost of capital. It's due to improvements in record keeping, better enforcement of property rights, many things that have gradually changed. But you see that interest rates intersect the x-axis sometime around the beginning of the 21st century. And with slowing population growth, with the increasing affluence of economies in places like China and India, the supply of savings is going to keep the yield on savings very low for the foreseeable future, probably negative. I think governments will have no choice but to have exclusively digital money to keep interest rates below zero. This will be an absolute necessity. And after not too much more time, it will become rather urgent. Let me come back to China, and I'll just show you this one slide about the migration of fee income out of the banking system and into the pockets of the duopoly of Ant Financial and WeChat Pay. So these are platforms that really didn't exist 10 years ago, but they have been almost universally adopted in China. And the message is that 40% of the fee income, even more than that, of the Chinese banks has been obliterated and has taken what was already a pretty shaky banking system and pushed it even closer to the brink of default and a huge national bank run that may occur at some point in China. So I think there's no choice that the Chinese government had to do something to rein in Alipay and WeChat Pay. They could have closed them down altogether, and they certainly have taken steps to restructure them and dismantle some of their monopoly privileges just over the past year. But developing an alternative central bank version of a digital payment system was an absolute necessity given the success of the 2 big tech platforms. Markus's writing, I think, is as lucid as anybody's on this topic, but there's no reason that the events in China couldn't repeat themselves in the West, that you could see Amazon and Google and even people like Twitter and Netflix and so forth entering this space and beginning to issue their own money. And I don't think people have any particular loyalty to Wells Fargo or Citi or Chase or whomever. and could very easily take their payments business out of the banking system and into the big tech ecosystem. The Facebook Libra project was an interesting stalking horse for this. We can talk more about Libra, which has been rebranded and relaunched, but I think the capabilities of big tech in this area are undeniable, and they will pretty much force the banks and the government to cooperate in some type of alternative. And we have seen successful cooperatives launched in countries like Sweden, in India, in fact, where there are now interbank payment systems of a digital character that are mediated by the central bank. And I would expect that before too long, something close to that is going to pop up in the US. It may grow out of that Hamilton project that is at the Boston Fed. But I think in the absence of something like that, the whole seigniorage of currency, may go out of the government and out of the banking system and into the pockets of Google, Amazon, Facebook, and so forth. And this is probably not an outcome that people would be happy about. Last point I want to make is that the US has a unique and very tenuous position in this whole market. We are the world's reserve currency, but we also have this export of hard currency. I think everyone knows that there is more physical US cash circulating outside the US than inside. And these are the proverbial suitcases of $100 bills. In fact, with the demise of the Boeing Max and the civil aircraft industry, one could argue that this is the last export that the United States really has. And there are really important reasons that the US would wish to slow down a CBDC and keep the physical cash circulating. But I think the hand of the American government is likely to be forced on this issue before too much longer. And it will be very interesting. There is, well over $1 trillion in physical cash offshore. And a lot of it is held by very unsavory people, drug dealers and petro sheiks and friends of Putin and so forth. Are we going to put all these people on a national blockchain when they come back and want to redeem the physical cash? More generally, how will this system accommodate people like tourists and foreign investors and illegal immigrants and so forth, who one way or another will need access to payment services? And I think a lot of these details are going to be very tricky, not only in the US, but in every country, really. But the US has problems that really exceed those, by orders of magnitude of any other nation about what to do with all the offshore physical cash. And there could be a one-time confiscation where we just cancel this, but I think this would be very bad for the balance of payments and the reputation of the country. So let me stop at this point. There's a lot we can discuss, but I find the range of questions and potential answers to be among the most compelling questions in finance today. And I'm really glad we're having this session.
Thanks a lot, David. There's a lot of things to discuss. We will come back to this, and the questions are already coming in from various people. So if you have questions, please type them up in the Q&A box. And it's good we have already a list of them addressing them. So the next speaker is Shin from the Bank for International Settlements, and he will focus on various aspects, including the more international perspectives.
Thanks, Marcus. It's great to join you and Darrell and David on this panel. I can skip the first slide, which is just a definition of what a CBDC is. Why might a central bank think about issuing a CBDC? Well, you can think of it as being one possible response to, if you like, this triple imperative that arises from the centrality of data in the digital economy. If we look at the corners of this triangle, these are the sort of three imperatives that arise from these features. One is the concentration and the network effects that David mentioned. Another important one is money laundering, safeguarding the system against crime, scams, theft, ransomware attacks, and so on. This more or less, I think, pushes us towards using real names, know your customer rules, so that we have an orderly market that keeps a check on the most egregious forms of illegality. But then that does raise, as Darrell said, these issues about privacy and data governance. So if we do use real names, how do we maintain privacy and how can we have data governance in a way that respects the the basic rights of individuals. And it, perhaps paradoxically, CBDCs may be one way, depending on the design, of actually safeguarding privacy and data governance. So I'll come back to this. So one aspect of the issue is this walled garden, where if you have the network effects, where the more users flock to a particular platform, the more likely it is, so the greater is the incentive to join the others. And this is another version of the chart that David showed. If you look at the mobile payment market in China, 10 years ago, neither Alipay nor WeChat Pay were really there. But now, of course, they're very large, and in terms of market share, which is the red dots, they have a 94% market share of mobile payments. Now, it's not the market share itself that I think is the issue. It's more how that market share is wielded, and the issue is really about what the rules of the game are. And I think this links nicely with Darrell's point about the nature of competition in the payment system. So how do we get from a walled garden to more of a public square? And the issue is, can we have an orderly market where the rules of the game ensure that you have data portability, and you have the technical data exchange standards that actually levels the playing field? So that even a big tech company, if they come in, they have to play by these rules of data portability and interoperability, so-called. And a good example is the UPI system in India, where of course they do have big tech players, but the payment system has the very rigorous rules about data portability and interoperability. Another very good example is a recent one in Brazil. This is even more recent. They rolled out this PIX, so-called system, and it's been around for just over a year. They've already signed up more than 2/3 of the population. And the other remarkable fact is that 50 million people have made a digital payment for the first time in their lives. And the really remarkable thing about this system is that it is very much this, if you like, the implementation of the payment system as a public square, where the central bank's balance sheet, in particular the liability side, the settlement accounts, is metaphorically the public square. So the central bank gives access to intermediaries, but for the privilege of using, of being able to settle in central bank money, you have to play by the rules. And that means sticking to the rules of data portability and interoperability that are actually ensured by technical standards. So it's probably not something that many of our US participants in the audience would be familiar with, but I think for those of you who have come from elsewhere, this is very familiar. You open the app of one bank, and then you can actually check your balances in all of your other accounts in the other banks as well. And you can actually initiate payments from the app of one bank from the account of another bank. And this is possible because there are, at the bottom of the system, there is a well-established personal ID system, a digital ID system that underpins all this. And then there are these so-called application programming interfaces, these APIs that ensure that there is confidentiality when you send this information. It uses public key cryptography that underlies, cryptocurrencies as well. And it's very, very smooth. And the question is, and this is a question that Darrell raised, if you have a system like this, do you really need the CBDC? Well, or another way of putting it is, if you don't have a system like this, are there even more lower hanging fruit than CBDC? And of course, as Darrell said, and I fully agree with Darrell on this, there are many more lower hanging fruits than CBDCs. It's competition, it's leveling the playing field, it's data privacy, and actually improving the access. So those are very, very important issues which apply to our current two-tier system, our current bank-based system, as well as to CBDC. On the other hand, so one question might be, what additional do you get? So what additional benefits do you gain by going the extra step of getting a CBDC? And another way of putting this might be, if you already have something like UPI or PIX in Brazil, another way of saying that is you're pretty much well on your way towards having the infrastructure that you need for a retail CBDC anyway. So I think that's the other way of putting it. You're pretty much the 70% of the way towards having a retail CBDC. Why? Well, because you have a digital ID system. You have all the APIs in place that ensure confidentiality of payment. It's just that the thing that you're transacting are the liabilities of financial intermediaries rather than the liabilities of the central bank. So that's the additional sort of step. Now, what might you gain by going the additional step? Now, I think a very important issue here is data privacy and data governance, and how do you have a real name digital ID system while at the same time ensure data privacy. Now, the way that we do it in a conventional financial system is to use this so-called jigsaw puzzle principle, where the bank or the big tech or other payment service providers may actually know one slice of what you do, but it's really only the individual that knows the whole thing. Yeah, so it's only me that I can I'm in charge of everything that I do. The other participants only have a slice. Of course, this kind of principle should also apply to the public sector, to the official sector as well. The central bank doesn't need to know everything about me. All they need to know, if they have a CBDC, it's just enough to transact. That's the same thing with the tax authorities or even the AML authorities. Now, the way that you design a CBDC is going to be addressing, could be one way to address these very deep and important data privacy issues. And I'm not going to have time to go into this, and Darrell knows this already very well. We covered it in our special chapter in the annual economic report last year, where there are different ways of designing a retail CBDC that actually can structure the information that goes to the central bank. You can either have all the retail transactions happening at the level of the intermediary, and only the net balance is going to the central bank, or you can have a separate masking of the identities. For example, that the central bank can observe the phone numbers, but only the phone company would actually have the link to the real name, etc. So there are different ways of designing these things, and clearly there needs to be overarching everything. There needs to be an overlay of the political guarantees as well. Now, the one example where the CBDC will take you one step ahead is in the international context. And that's because the way that we normally transact cross-border is through the correspondent banking system. Why? Well, because the way that we make payments in a bank-based system is we ask our bank to debit my account and credit the account of the receiver. Now, if the receiver is also a customer of the same bank, then my bank would just debit my account and credit the account of the receiver. If the receiver is a customer of another bank, then there has to be an interconnection between those banks. And if the receiver is actually a bank customer in another country, then we need to have a much longer string. And this is where the complications come in. Now, part of it is technical, but I think there's fair consensus that most of it has to do with compliance, the various the policy-related issues that are actually there for good reason, AML, CFT, know your customer rules, and so on. but they tend to inject a lot of frictions into the cross-border payments. And we may think that this may, at first blush, this may seem somewhat tangential, but think about crypto and the way that the whole ecosystem of DeFi or Web3, as it's now sometimes called, has evolved. Crypto, Web3, these are inherently cross-border. And so if you're going to have a payment system that is going to be a match for crypto or Web3 or DeFi, we have to anticipate developments. So even if you don't think you need it right now, you will need to foresee or anticipate where you'll be in 10, 20 years' time, rather than the next year or two, because it's going to take 10, 20 years for one of these things to come about. Now, if that's the case, then a CBDC really does come into its own, because even though you have a well-functioning domestic payment system, and it's publicly run, and costs are zero, you're not going to be able to transact globally, because that payment system is something that's run by the central bank, and the central bank has its boundaries. So what I thought I'd do is just to give you a kind of update on where we are as the BIS on some of our projects. And for this, let me just introduce a couple of words on how you might interlink payments. One simple way is just have a bank that is a member of two systems, and that bank can be a kind of an intermediary that's a member of both systems. Another way is to have a bilateral link where two jurisdictions which have very similar rules, very similar technologies, can actually link up. And of course, that is easier for geographical neighbors with very similar legal and administrative systems. Another approach, even with a conventional payment system, is the so-called hub and spoke, where you can link payment systems like PIX or UPI through a common, if you like, a infrastructure that actually underpins them. And one example of this is the so-called Project Nexus that we're running out of Singapore. But what I want to do is to focus on, if you like, the logical limit of this sequence, which is the common platform, where you have a common platform where more than one jurisdiction can actually then have its money trading. And this is almost invariably going to imply some version of a CBDC. So what we're doing, and let me just mention three projects that, and we can come back to this, Markus, if there's interest. So there's one project called Jura, which is something that we're working with the Swiss National Bank and the Banque de France. And it's linking, so this is a wholesale CBDC. This is not yet retail, this is a wholesale CBDC. We're using Corda. So Corda is not, it's DLT, but it's not putting transactions in the block and then you're having proof of work or proof of stake. It's linking bilateral chains of transactions. Then you hash the transactions so that you can sort of be assured that someone actually has the balance there to pay. But one feature of Corda is that there is a notary who actually says, okay, the transactions up to now will now write into the book, and so all the transactions are final. And in this case, there's one notary for each currency between the euro and the Swiss franc. And this is something that we've already trialed, and there was a recent paper about this. Another example is this thing called the project MCBDC Bridge, or just MBridge for short. And this is work that we run out of our Hong Kong center, and we're partnering the central banks of Thailand, Hong Kong, China, and the UAE. And this is an interesting one because the prototype actually runs on this platform called Hyperledger Bezu, It used to be called Pantheon. It's basically an Ethereum client, and the consensus mechanism is proof of authority. So basically, there are no coins here. It's real money that we're talking about, and it's the central banks who are the validating nodes, and the commercial banks are the standard nodes. But this is something where you don't need coins to incentivize people, because it's the central bank's job to actually execute the transactions. It's a direct model in the sense that the transactions happen directly without having kind of intermediaries that do the AML. That model is so-called the hybrid model, which is the one on the right. This is Project Dunbar, which we run out of Singapore, and there it's us with Australia, Malaysia, South Africa, and Singapore itself. And again, this runs on either Corda or Quorum, which is this is the platform that JP Morgan Coin runs on. And this one actually has this hybrid element where, depending on the currency, you would have to run it through your sponsor banks in that monetary system, and then they would actually conduct the AML for you. Why would we do it like this? Well, to the extent that we're using real names, we will need to have the AML checks. To the extent that we have central banks, we don't need to incentivize them by having coins. We're not selling coins. This is just the central banks doing their jobs. And because no one central bank is going to be able to straddle the whole globe, this is where the DLT actually becomes pretty much essential, in that you need the central banks to be working together on a kind of common platform like this. Anyway, let me just stop there now, Markus.
Thanks a lot, Hyun. That gave us a lot of insights on privacy and also on the international activities at the BIS. So let me come back. There are already some questions coming in, so I would like to pick them up. But before I do this, I would like to go back to Darrell's payment failures. He mentioned 3 payment failures, in particular in the US, where the cards, because of this two-sided market feature, can really charge 3 times as much as in Europe because of different forms of regulation. But I would like to come back to the interest paid on deposits, why they're particularly low in the US, or also in Europe and other parts of the world. And perhaps I might sound a little bit like a bank lobbyist, but let me just make some cases where there is some arguments that actually there should be, the bank should be granted special rights to create money in form of deposits at a low interest rate. And I should say I'm not totally convinced by that, but just for the sake of the argument, let me make this. So one argument which is often brought forward is that banks have some synergies between granting loans, in particular for extending credit lines, and having deposits, because whenever there's a crisis, there's an inflow of deposits, and then it's much easier to extend credit lines. So you would like to combine the 2 activities, and that's why you should not compete with CBDC, and impose a higher interest rate on deposits. That's one argument. Another argument is that banks, if they run very thin margins, they tend to be much more risk-taking because they don't have any franchise value. So if we give them some general monopoly profit, or as Gary Gordon often put it, there's a lot of sticks, supervisions, we have to give them some carrots too. And the carrots we give them are in form of monopoly rent, so they can actually issue deposits at a very low interest rate. So what do you say to these arguments, in a sense that these are arguments in favor of granting banks this monopoly rents and these favors to limit the risk taking and also exploit the synergies which they couldn't exploit otherwise? And we shouldn't compete too hard with CBDC against that, or with other regulatory measures, narrow banks or whatever. Perhaps you can make your case. I'm more on your side, I must say, but these are significant arguments. One has to have some counter arguments against it.
Yeah, Markus, can I address? I'll start with the synergy argument, which I agree. There are significant synergies. For example, when a credit line is drawn, the most convenient place to put it is in deposits at the same bank. So it makes sense to combine credit provision and deposit taking. And from the very fact that there is synergies, one must ask, well, why do the banks therefore need protection from competition? If they have a synergistic advantage, shouldn't that mean that competitors should be allowed to attempt to compete with them? And if the synergies are really there, the banks will be able to fend off the competition by combining those two activities.
Can I just interject? But one might argue the central banks are such unfair competitors with CBDCs that they can, you know.
I agree with that, and I also saw a question in the question and answer about the competition associated with interest rates on CBDCs. I think CBDCs will not pay interest in any plausible scenario in a country like the United States, purely because of your point, Markus, that the central bank doesn't want to compete on the deposit interest margin with banks, but it's quite happy to compete, well, not in the US yet, but in some countries, on the margin of payment efficiency, offering zero compensation, but high degree of interoperability and efficiency. Again, a margin of competition on which one should allow banks to defend their turf, if necessary, by raising deposit interest rates and losing profits, but not to the point at which they would lose this synergy, because the very fact that they have the synergy will allow them to keep the synergy going. They'll be able to fend off the competitors. On the other issue that you raised, Markus, about, well, if you make them very profitable, then they probably won't take a lot of risk. I think we might have learned our lesson on that one. Although as a Canadian, I must say the Canadian banking system is often viewed as very stable because it is so profitable and nobody wants to give up such a big cash cow. But I think overall, the evidence, at least in the US, suggests that the way to control risk-taking is through regulation of risk-taking rather than through granting monopoly style profits. But I'd be interested in what others think on that.
Could I make 2 points?
So David, can I just throw one more thing in where you pushed very much for negative interest rates? Perhaps you can connect it with negative interest rates as well. But
well, there's a huge distortion in this market, which is the free deposit insurance that is not priced and, you know, is pretty much a mandatory. It's a gift really to the banking system, paid for indirectly by all the taxpayers. And it greatly affects both the acquisition of customers and the rates of return that they earn. I think the negative interest rates is purely a behavioral finance problem. And with time, people will probably get used to the idea that if you are getting -4% and the bank is lending it out at -2%, it's the same as the net margin of 2% that you have now. But it's going to take people some time to get to that point. But the synergy that both of you spoke about so glowingly has, to my mind, really never been exploited well by banks. There are so many great fintech research papers, and my favorite is the so-called digital footprint paper, where if you simply know the identity of the mobile phone carrier, that gives you a better idea of the credit riskiness of the customer than all this other stuff about income and payment history and so forth. But there is so much information about people's transaction histories and repayment behavior and so forth that the fintechs have gotten very good at harvesting. And I think the best example of this is clearly Ant Financial and Alipay, which very quickly became the biggest bank in the world. As you know, it's not even a bank, it's a shadow bank, but became really skilled at data mining and creating exactly the kind of synergy between having the float on consumer payments and lending that float out that the banks have never been able to do in the United States. Our banks are really backward and unintelligent and have never invested in this area. And there may be regulatory reasons or privacy reasons that they feel that they can't. But I just disagree with the premise of your whole question, Markus, that there's a natural synergy. If there is, I don't think it's ever been taken advantage of.
So your colleague Philip Schnabel actually in the Q&A says, oh, there's other services like ATM branches and so forth, the banks provide as well.
When was the last time you were at an ATM? I mean, I do it all on this mobile phone here, and all the ATMs in New York are closing because nobody uses them anymore. I can also bring up my colleague Thomas Philippon, who says that the 2% transaction fee hasn't changed since the 1970s. And look at what has happened to, say, brokerage fees on the stock exchange, which have gone from some monopolistic number down to zero in the space of about 40 years, where the transaction fees in banking are just completely fixed for, as far back as we can measure. I think, it's an industry that if it's overtaken by fintech and if parts are hived off by central bank digital currencies or by other providers, nobody will miss the banks. I think they do nothing but exploit their monopolist position, and it's overdue that the gates are raised to allow more people to enter and compete with them.
Very good. Any Hyun, do you have any take on that?
Yeah, I think what I didn't have time to get into was what the architecture might look like if we have a CBDC. I think even with a CBDC, the basic two-tier system, I think it will still be there and will still serve a very important purpose. I think the consumer-facing activities are best done by the private sector, but the role of the central bank there is to provide the foundations. I mean, can I come back to one point, which is, no one's actually raised this, so I was just waiting for someone to raise this, but no one has. I mean, typically when you raise the issue of a CBDC, someone in the audience will say, "Why do we need a CBDC? Isn't this a solution, in search of a problem?" I think there is an element in the profession, especially in our profession, which tends to look at the two-tier system in a money and banking textbook as if you like the epitome of what a payment system would be, what a monetary system is like. And it's like the evolutionary equivalent of the shark. It's so well developed that we cannot envisage any kind of further development, of that model. And I think that is probably a little bit too narrow, a little bit too, very much thinking of the current system as being the epitome. If we think about how we actually arrived at the current system, it wasn't that long ago that we actually had a very different system, and so we have evolved. But I think we should also be, if you like, formulating policy, thinking about these issues in anticipation of developments. And as David has also remarked, Alipay and WeChat Pay just were not there 10 years ago. 10 years is an age in this, in this field. And so I think we should be a little bit more, forward-looking about this, not for its own sake, but because the system is changing. I mean, look at what's happened to crypto and DeFi. And, who are we to say that, they will disappear? I don't think, they look like, things which will pretty much stick. Now, what form they'll take, we don't know. And of course, there are lots of problems. And, we don't have, this session for that discussion. But given all that's happening, we as a profession cannot simply bury our heads in the sand and say, oh, this will just go away. This is not the evolutionary equivalent of the shark.
Can I just follow? I mean, just to understand, I don't fully understand. So we need CBDC or we don't need CBDC? Did you answer this question or not? Looking forward.
One way of...
Oh, yes or no?
But I also agree with Darrell that there are many more lower-hanging fruit, especially in some countries. I think for the US, there are many more lower-hanging fruits there than a CBDC.
Darrell?
I like Hyun's metaphor of the public square. SPAY in Mexico is getting there. PIX has done a lot. UPI and Aadhaar in India together have made for a payment system that's much more innovative, interoperable, and inexpensive and accessible. And there's no reason not to attempt some of what Hyun calls lower hanging fruit. But of course, given the very long lead times to develop the design of a CBDC that Hyun laid out in front of us, one should develop that as well so that the option is available if and when it becomes clear that it's needed, and that whether due to political or or other market failure reasons, the project to improve the bankroll payment system is not going to work sufficiently well. So dual track CBDC development and improving the competition and innovation in the bankroll payment system by all of the methods that Hyun described us. And then in the cross-border arena as well, MCBDC is a fantastic project that can improve the efficiency of cross-border payments, which is a poster child of inefficiency.
Okay, so let me just also weave in some of the questions which came in as well. And one is by Bill English, who actually doubts that, David, you essentially said the CBDC will come and cash will disappear, but most policymakers, they talk on CBDC in addition to cash. So it's not obvious that, cash will go away altogether. And hence there's still an effective lower bound somewhere. And I would also inject, talking to Germans, for example, if you were to go negative in interest rates, they would lose the trust in the currency. So there's a huge, you might call it a behavioral element, but there's also an element of trust in a currency. If you go huge negative in the interest rate, at least in the foreseeable future, they might switch to something totally different and lose the trust in the currency. Well, what do you say about these concerns?
I fully understand. I've spent a lot of time in Germany, and it's so different from even the neighboring countries in terms of the way people behave with cash. But if the government can't pay negative interest rates, it's going to have to collect a lot more taxes or shrink the size of government. And it's going to be a very difficult choice that the public is faced with. I don't disagree with you, and you know more than I do about the trust that Germans have in their currency and so forth. But the only alternative that we have in public finance is collecting a lot more taxes. And I think as unpopular as negative interest rates might be, higher taxes are even more unpopular. And maybe this will indirectly lead to shrinking the size of the government, which would make other people happy for other reasons. But what you're looking at here are some first order questions in public finance. And when you ask, do we need CBDC? I think there's a difference between needs and wants, but if it's not created by the government, it's going to be created by Amazon. And the seigniorage will go to Jeff Bezos instead of going to the national government. And again, more taxes would have to be collected instead of printing money. So there are some very unpleasant trade-offs, but the whole nature of government funding is being thrown up for grabs here. And the challenge from big tech, the decentralized lending pools and liquidity pools, which are growing at hypersonic speeds right now, should not be underestimated as viable alternatives that will bleed off people from the mainstream banking system if there isn't something put out there by the government to respond to it.
So I see a very different take from you compared to Darrell and to some degree to Hyun, where you are really favoring the CBDC. Let me just throw something in. Darrell and Hyun, can you imagine a world where the citizens have no direct access to public money anymore, only through the banks or through some fintech companies? And there's essentially no convertibility. Right now, I have a bank account. I know I can convert it to something which is from the central bank, from the government. Once there's no cash anymore, I cannot convert it to anything which comes from the government, and it can take on its life on its own. Of course, the government can regulate all these entities, what the heck out of that. But I, as a citizen, I cannot convert it to something which is public money. And then there might be, the uniformity of money might go away. The unit of account might move somewhere else. Isn't there a danger like this? And CBDC would help to protect the unit of account control by the central bank?
Let me take a shot at that and hear what others have to say. So Sweden is facing essentially this situation right now, and that's why it's seriously considering the introduction of an e-krona. If you're in Sweden today, I remember my last visit, I think you were there, Markus. I tried to pay my hotel bill at that hotel in Stockholm where we had that meeting with paper money that I had left from my previous trip. They wouldn't take it.
Yeah, I got laughed at when I tried. They said, "Are you a tourist?"
So Sweden is basically where what you described right today, and the Riksbank is very concerned that there's no tangible access to central bank official money in the general population are not much, and it's disappearing fast. What goes wrong? Well, I'm not sure, other than there's some sort of ephemeral sense of you don't have an official connection to the government's money anymore, but the system keeps working. And after all, most of us are not touching government money most of the time. As David said, who's visiting an ATM machine anymore for paper money? I hardly ever do, except maybe for my barber. So I don't think it's as crucial as some would suggest. And there is, well, let's take Alipay and WeChat Pay. David and I might have different views about how effective that approach is for payments. It is true that they were unregulated with respect to fees, and their fees at 60 basis points were kind of high, but it was central bank money backing it 100% by regulation. So everybody did have a claim that was effectively as good as central bank money, and everybody loved it. It wasn't that much of a problem with it. The government stepped in, I think, not so much to reduce the degree of market power. They were doing that anyway with regulation. I think they put in a CBDC in part to reduce the social power of those two private enterprises and to increase the position of the state-owned banks in China. So I think it's a slightly different situation, and tech firms can be regulated and are regulated and need more regulation in the United States, but regulation is available.
I mean, an alternative argument would be that you need an outside option, even though if it's just a threat of an outside option, you can convert it to public money. But you would say regulation and other measures like FDIC insurance would be enough for a government to maintain the unit of account and also control inflation and so forth. But
the US didn't have, well, go ahead, Hyun. I think I don't want to break in, but the US didn't have a central bank until 1914.
I was going to sort of disagree slightly with Darrell on this point and back you up, Markus. The central bank issues the ultimate unit of account, and so the trust in the currency is about the trust in the central bank. Having a direct claim on money issued by the central bank, does provide governance benefits, I think, in the sense that it provides a kind of tangible marker of the trust, in money itself. And it's probably more than just the outside option. There is a kind of tangible link there, which I think is important, even though it may be a small part of your portfolio. It may be, playing a much more important governance role, symbolic role. I think that really comes home when we think about a payment stablecoin. So if you have a stablecoin, the backing assets, need not be central bank reserves. It could be other financial assets, even if they are safe assets like treasuries. It's not, of course, it has no credit risk, but it's not central bank money, directly in the way that the two-tier system, would actually be. And so, in that sense, you would have this idea of another version of money in the system that is a distinct version of money as compared to central bank money. And if that's the case, and that big tech stable coin, in fact, were to become very large, I think we can, look ahead to a possible fragmentation of the monetary system in that respect. And if it's a big tech stable coin, this is almost certainly going to be a cross-border operation. And so, you would think about this fragmentation on a much larger scale. Now, to the extent that money is a coordination device, if you have fragmentation of money in that respect, I think that would, the economics of that, I think, doesn't, speak well of the ultimate welfare effects, let alone the governance aspect. So I would, of course, regulation, etc., is very important, but I would be on your side a bit more, Markus, that this tangible marker of that trust in money, it does play a role. Add another question. So Andreas Park, actually, in the Q&A box, he asks, are we focusing too narrowly only on payment and should focus much more generally on general infrastructure? And should the government provide some public blockchain in a sense? And it goes a little bit like almost to DeFi. Does anybody want to pick up this question, that we should actually see CBDC not only
from the angle of providing a payment structure, but much more for a generalized financial architecture. And perhaps I can interject a little bit, what's about features like programmable money? Should CBDC also be programmable? Like in Hangzhou, for example, the Chinese government issued some coupons which expired after 30 days or something like that. And this way, they made sure the stimulus money is spent rather than saved. So we can have much more creative types of money, which of course destroys the uniformity of money. There are some coupons which is like an oxymoron, as I mentioned before. Programmable money is not the same money. If I have one money which expires and Hyun has a money which does not expire, it's not the same anymore. And then we use the common unit of account or the uniformity of money. Perhaps, does anybody want to chime in on that?
Shall I start? And then Darrell and David, please come in. So Andreas, that's a very, very good question. And in a way, my last slide was really addressing exactly that question. If we have an MCBDC, if we have a multi-CBDC bridge, one of those cross-border CBDC projects, that is exactly the kind of public, public in the sense of a public sector blockchain. In terms of programmability and what it could do, we don't need to go, Markus, to voucher type, expiring money to really think about programmability, because even very important issues in security settlement, like payment versus delivery, payment versus payment, these kind of contingent payments, this has been the bugbear of security settlements now for many, many years. And in one of our projects, the project called Helvetia, which is something that we run with the Swiss National Bank, you can actually have that. You can actually program that in the wholesale CBDC, so that you have the delivery versus payment as part of that feature of the CBDC itself. So you can actually then have. So this is a kind of smart contract, but in a very conventional sense. And but I fully agree with you on this potential oxymoron of the notion of programmable money. I mean, money is the most, if you like, state uncontingent claim that one can have. So the notion that it's somehow programmable, does sort of smack of being more like a digital voucher than money itself. But clearly there are possible applications. Now, Andreas, I think the only issue that I would raise is that in the kind of blockchain that I sketched out at the end, there are no coins that are being sold. So these are central banks doing their job. So it's their job to execute the payment. You don't need to incentivize them with coins and selling coins to people who come in order to do their job. You can actually have these things up. And if you have proof by authority, in other words, you have to be a central bank in order to actually write on the ledger. You can have all of these things being done in the way that the system works currently through public accountability. And I think that's the kind of the alternative vision, if you like, to all that's going on with crypto. I think that the way that that's going. That there is clearly a lot of excitement there, but think about it. You need incentives for the validators to do what they do, and that means that rents are a feature and not a bug. And I think this other vision, I think, is a much better one, and I think would be much more appealing to economists.
David, when I first started engaging with crypto about 8 years ago, I went to an event in New York, and one of the other people there was Jim Robinson, the former CEO of American Express. And I made some remarks about the limitations of Bitcoin, and Robinson accused me of what he called legacy thinking. He said, that's legacy thinking. You need to think in terms of programmable money and decentralization. And it was a scolding from which I've never recovered. And I think this is one of the worst things that academics can do, is to be stuck in the models of the past. And Markus, I know from your own writings that you don't fully believe, the questions that you're asking. Your own thinking is very much against the spirit of some of these. But The programmable money is already here. It's on the Ethereum platform. It's on places like MakerDAO. Things like settling the collateral for a borrower who defaults, settling the transfer of securities titles, very basic, but also much more elaborate things in risk management can be programmed directly into smart contracts. And to the extent that we don't have government assets that can interface with or even do the same things, they will become increasingly irrelevant. I think the central bank, Andreas Park's question is exactly along the right lines, that we shouldn't be trying to patch over and bootstrap the system that we already have, but to take advantage of the really imaginative technology. And for government policymakers, to bring it back to the example of the money that expires after 30 days, there was a team in the Bank of England, the Future of Money team, that was launched when Mark Carney was the governor, and they put these ideas front and center, that governments could fine-tune economic policy, you could get fiscal stimulus to exactly the people who need it for exactly the period of time that they need it for. And it is something that could greatly improve all of the economic management done not only by central banks, but also by ministries of finance and treasuries and so forth. And not to try to take advantage of this would be just a glaring omission by governments, a huge opportunity missed that will be seized by people in the private sector on these decentralized platforms if governments don't stand up and try to use the same tools.
So
can I add to that, Markus?
Follow up on that? Oh, yes.
Yeah, Markus, can I just add a bit to Andreas's question? I totally agree with Hyun and David. The promise of technology in this area is really exciting. The Internet of Things, DeFi, developments in this area are going to be very important to the future digital economy. But what can the government do, I think was Andreas's question. And from my point of view, right now, the government has not provided a clear roadmap to how innovators can enter these markets and be assured that they're going to be earning returns on their investments in technology, because it's not clear yet what's going to be allowed and what's not going to be allowed, who's going to regulate what, for what purposes. And so I think the best thing the government can do is to develop a clear legal and regulatory pathways for the private sector to come in and to comply with what we need, consumer protection, legality of payments, and so on. But the US government is not the most promising of technical innovators. It can work with the private industry together in consortia. National laboratories could be devoted to helping with the development of infrastructure. But as far as laying out the infrastructure on a government platform, I mean, maybe there's going to be applications, but I would be somewhat cautious.
Do you see any competition across governments, that certain governments are more innovative and lay out the roadmap much more? Can you
Absolutely. China's way out in front on developing central bank digital currency. And if you look at the ecosystem that they've put up for ECNY, it's very impressive. They're also, as Hyun mentioned, participating in MCBDC Bridge. And they're getting out in front, and a lot of people in Washington, D.C. are raising the alarm bells or ringing the alarm bells over the U.S. falling behind. Setting standards is also an important way that China is moving out in front. So I do think that other governments should take the mantle of leadership and start developing the technology so that they can participate in CBDCs and setting international standards.
But to what extent can you set up a fixed roadmap knowing that everything is changing? Now, you need some flexibility down the road as well. So you have to be, on the one hand, give a clear path forward. On the other hand, you have to have enough flexibility that you can readjust later on if things go out of hand. Do you have any guidance what the balances are and what are the criteria to look for?
Tough question. I've been at a few meetings in Washington. I'm sure Hyun has sat in on quite a few meetings at which these exact issues are being hammered out. The recent US report on stablecoins, the President's Working Group report on stablecoins, says in the end, we need legislation so that we can regulate, so that the only issuers of stablecoins are banks. I'm not convinced by that argument. And that's only one element. I think you have to have a plan that covers almost all of the issues that we've discussed today so that as if you look at the puzzle that Hyun's diagram had, all the different interlocking pieces, you really can't design one part of the puzzle without knowing what the other parts of the puzzle are going to look like. So it's a huge complex issue.
Can I just go to a question by Pradeep? Oh, Hyun, do you want to add in particular to that?
Yeah, so I think Darrell's point about regulation, I think, is really important. And I saw that both Markus, you and Darrell were listed at the back of the President's Working Group report as having been sort of consulted on this. You know, the PWG report, I think, is a very, very important one because it does, you know, I think address, you know, many of the issues that we're talking about. Now, when we think about crypto, by its very nature, you know, crypto was meant to be, if you like, censorship resistant and, as it were, inherently, if you like, you know, outside the traditional, you know, perimeters of regulation. And I think it does pose a puzzle for all of us, because if we want to you know, to be accommodative and actually bring it into the fold and actually have it part of the conventional system, there has to be a way of, you know, accommodating these features of crypto and DeFi within the conventional financial system. And that means, first and foremost, how do we make it consistent with real names? So AML, CFT, know your customer rules. How do we do that? Because by its very nature, a public blockchain, Ethereum, Bitcoin, all you have is the address. You know, one person can have, you know, many different addresses. By its very nature, it is not tied to a personal name, or, you know, doesn't need to be. So how do we bring it, you know, bring that into the fold of the conventional financial system? And I think, you know, the PWG report, I think, did a very good job of at least taking, I think, a very, you know, high level view of that, and you know, proposing a couple of ways forward. And I think you know, you may disagree about the actual fine details, but in broad terms, you have to look at the points of contact between crypto and the conventional financial system, and have a way of bringing real name accountability, so that whenever, you know, there is a point of contact and there is a spillover from the crypto world to the conventional financial world, then we actually know what's going on. And I think that is really a cornerstone for maintaining the you know, the integrity of the system. Now, in the PWG report, you know, they recommended that only regulated banks can issue stable coins, and that wallet providers of all kinds, you know, would need to be regulated in some way. I think Darrell disagrees with the first one, but I think, you know, something of that nature, it doesn't have to be exactly that, but something like that, I think, will need to be in place so that the points of contact, yeah, are within, if you like, the broad legal system, the broad set of rules that actually maintain the integrity of the system.
Can I follow up on this with Darrell? One question, a particular question. So what I envision what could happen, that there are a lot of private stablecoin providers who issue stablecoins. Through the ICOs, they can create a lot of seniorage revenue, as David pointed out. And then later on, there will be, by the regulators, rubber stamped, as you know, you get this lender of last resort feature if you do this and this and this. And essentially what you have created for these private firms, many of them got really wealthy because they could issue essentially money. Are you worried about this? That, you know, we have a process where, you know, everybody's just rushing to issue stable coins, gets wealthy, and then later on it will be rubber stamped. You know, that's actually real money, and then gets a lender of last resort features, get all the other things, and it's a little bit unfair in the society to give certain people such, you know, privileges.
You mean like we give banks today?
For example,
we call this a first mover advantage, don't we?
Yeah. So, you know, with regard to this, I think it connects directly to what Hyun said about the proposed legislation that only a bank could issue. I think an event that stablecoins are going to be reliable, Hyun had it right. They have to be effectively regulated banks. The question is, Are they going to be new kinds of banks that are providing payment services and are not subject to all kinds of other regulatory provisions about general banking that would make it very expensive for them to do that? Or are they going to be neobanks that are, restricting their services in a way that would be safer and potentially more competitive? If they offered zero interest and got a lot of seniorage, probably another bank would come in and say, I will offer 10 basis points more than zero. And then another one will come in and say, I will offer 30 basis points more than zero. And pretty soon we'll have competitive, effectively deposit taking into a new banking system. And the old line banks will start to get in on the action. And pretty soon we'll have a vibrant market for payment services. Now that's the ideal scenario, is that there's good competition. The bad one is that the regulations, whether for CBDC, by the way, or for stablecoins, basically says the legacy banks are in charge. Same with FedNow. Legacy banks are going to be in charge unless regulation is designed to open up the space. So I actually am more positive on allowing entry into the banking market and regulating carefully for the functions that are provided.
David, so can I just interweave? So brother Yadav, he's actually asking about cyber warfare as well. Perhaps you can move to the next stage. Is CBDC, is this a problem that it might open up much more to cyber warfare? If you have cash, it's very hard to manipulate. At least we know how to. We can't do it in milliseconds, but there might be through cyber warfare, you can take out the payment system of another country, in particular, if it's to some extent managed by some international corporation anyway. To what extent are there geopolitical uncertainties, and how does CBDC, does it make things worse? And how can we manage that risk?
Well, I think, first of all, we've already arrived at this point, in some of the ransomware events that you might remember from last summer are probably a window on the future. But I think the cyber warfare tools that are being developed in the Langley laboratories and the Soviet or the Russian state security services, the North Koreans, these are very formidable. And we have a system now that is largely decentralized, where most of your money is in a range of banks, or you have balances on credit cards. And I do think that centralizing a lot of these under the control of the government may create single points of failure that do increase vulnerabilities. So it definitely needs to be a matter of concern. And I think in the long run, it may push you toward more decentralization, to not having uniformity of money, to having money on decentralized platforms as opposed to under government control. It may be inevitable. I think we're quite overconfident about the ability of government to regulate this, to impose standards and get people to follow those standards. I think not only cyber warfare, but things like quantum computing, which will be able to unravel hash functions and lead to attacks on the consensus protocols of different blockchain systems. All of this is coming faster than people would want it to come. And it's going to put a premium on having good cybersecurity skills, both in the government and the private sector. There's no substitute for investing in these competencies and hoping that we stay ahead of Putin. But I wouldn't for a moment be in denial about the risks and the dangers.
But isn't there a problem that private companies never invest enough in security because there's a positive externality and you underinvest because of that? And the government can internalize this externality and hence invests more in cybersecurity? Or does anybody else want to chime in on that cyber warfare question as well?
Yeah, I think Markus, I think the implicit assumption behind the question is that somehow CBDCs are more vulnerable to cyber attacks. Not sure that that's exactly right. I think cyber risks are already present, and it's something that, of course, all commercial banks, other private sector institutions, and of course the official sector, we're all very, very focused on. And it's not something that is, I think, uniquely applicable to CBDCs, unless you think somehow that there is a way to attack the consensus mechanism in a way that would actually unravel the whole chain, or at least that, although that's not the way that at least in the way that I showed you at the end, that the CBDC projects are being envisaged. And in a paradoxical way, you could argue that in a decentralized system, where there are lots of copies of the ledger that are distributed and it's governed in a very decentralized way, that gives you a lot more robustness, against these operational risks. And so I don't think it's correct to say that CBDCs are any more or less vulnerable. You could argue that it's less vulnerable, but you're absolutely right that cyber risks are very, very important. And I think it's something that we've got. And Markus actually wrote a whole book about this, the difference between robustness and resilience. I think this is exactly the right kind of approach to cyber risk, in that I think gone are the days when we can say we've put down some steel walls that will ensure us 100% against cyber attacks. I think it's more about resilience and recovery. And I think that's the way that certainly the private sector institutions have actually taken it. And I think that's also the thinking that is also in the official sector when we provide guidance on these kind of issues.
Can you give us a sense, in the official sector, how much emphasis is there on cyber aspects, cyber risk aspects relative to other design issues of CBDC? Is it like 20% of the time is just spent on cyber security issues? Or is it a much smaller percentage? Just to get a sense what's importance attached to that.
I think in terms of the resilience, the design of the consensus mechanism, I think would be very much an element of that discussion. The example that I showed you at the end, I mean, those are pretty well-known ones. I mean, they are like enterprise DLT products that have been around for many years. They've been tried and tested, and they were designed very much with a kind of real name application in mind. These are not the anonymous public blockchains and with coins, with incentivizing either the validators or the miners to keep the system secure. I mean, it's a really much harder task to keep the system secure when you have to construct it as an equilibrium of a game by incentivizing the gatekeepers, than it is to have a system that's based on a few, and there are only a few central banks that know each other well, that trust each other. Of course, they all come to the BIS for our regular meetings, and that's just a much more robust system. So I think I mentioned Corda earlier. The way that Corda works is that rather than writing transactions into a block and then just appending the latest block to the chain, you're actually keeping track of the individual transactions. You need that because otherwise, if you're using real names, you don't want all your transactions to be broadcast to the whole world. So you need to maintain privacy as well. But you use the cryptographic techniques to actually track the unspent transactions, so that you can be assured that anyone who pays something actually has the funds to pay it, and then you have the notary that makes things final. I think these things are pretty well well tried and tested, but of course as we always say, there's no room for complacency here.
Yeah, I would like to add I do agree with what was said, but I think the whole discussion simply raises the imperative of getting started on the technology development. What we've all described is an aspirational system, a bulletproof central bank digital currency that protects privacy and is efficient all at the same time. It's a multi-year lift. And it is, in my view, it's something that you need to spend the resources. The leading computer scientists in the United States working on these topics, like Dan Boneh here at Stanford and Neha Narula at MIT, are optimistic that this can be done, but it's going to take many years to do it. And in the meantime, they're pessimistic that existing technology can provide what we've just described.
So perhaps move on to a new topic, or with a topic we covered a little bit, so privacy, and then I would like to move to the international aspect at the end. So we talked about privacy already, and Darrell mentioned it, and Hyun mentioned this jigsaw puzzle approach. I was wondering, with all this new artificial intelligence, isn't it much easier to solve the jigsaw puzzles so this way? And I think it goes a little bit into David's remarks earlier that, you know, these fintech companies, they can just combine data. They might not see the whole jigsaw puzzle, but they see enough pieces and they can figure everything out, because we have now new tools, new, you know, deep learning and other tools, which really help us help these companies, these fintech companies or other companies, get a clear picture of what's going on, and privacy is much more under threat. Now, I want to come to a second perspective. Should we protect the privacy of people from the fintech companies or from the private companies or from the government? Where do people feel less comfortable to share the data with? And it varies a lot across countries. Some people are much more concerned in certain countries about their government, and others, they're much more concerned about big companies. How should we square this? And, you know, once, if people are very concerned about private companies, CBDC looks very good. If people are very concerned about privacy towards the government, CBDC might be less the way to go. Any reactions to that?
You know, it's an area where the cultures of different countries have placed very different values on privacy. You know, I think at one extreme are the Scandinavian countries, where you can look up a whole bunch of personal information that would be unthinkable in the US. But it's also intergenerationally changing very quickly. With social media today, young people, and I have 4 kids who are in high school and college, and the kinds of stuff that they're comfortable circulating on these platforms just shock their parents. And I think we shouldn't be naive that there aren't people out there vacuuming this stuff up and storing it and mining it. And it's, I think we'll regret it, but privacy may already be gone to the point that it's unrecoverable. And I'm not sure that people in the next generation even care that much. They've adapted, they have different frames of reference. And it's ironic that the people who created Bitcoin were part of this cypherpunk movement in California, who had privacy as a central core mission. You know, really, they wanted a private digital currency, and they got it exactly wrong. It turns out that Bitcoin is the least private thing ever invented. And I think there's no going back to the way things were, you know, in generations past, and we just need to get used to that.
But that's very fatalistic. Any more optimistic?
Sorry.
Gloomy, David.
There's 2 issues, Markus, in your question. One is, do you trust your government more than your bank? People are happy to give up all kinds of data to their bank that they wouldn't think of giving to their government. And the other issue is, do you want to centralize the data or not? And here's where Hyun's point about decentralizing the data is extremely important. And I think a lot of people separate those issues, but as David said, it varies by country. In some countries, I think China, for example, I mean, whether you like it or not, you learn to live with the fact that the government has your data. I think there's a strong minority, or perhaps even majority, of Americans that simply don't want the government to know everything about their private payment. And I'm, you know, maybe we have to give up on that, David, but I would work towards solutions that don't require that, and of the cryptographic sort that Hyun described earlier. And I think there is some promise in that. It is a bit ironic that we're talking about the benefit of CBDC, where in the current system we do have already decentralized data repositories, one for each bank, protecting its own customers' data. It's not a perfect system, as we all know, but if you centralize it all, then you really have a lot of eggs in one basket.
I'm not sure it's either or, though. I think there will be clienteles for this, that, you know, people who really value privacy will avoid some of these platforms, and vice versa. And they'll coexist in all likelihood.
But our society might be much more fragmented in, you know, different subgroups, specializing and perhaps not interacting with other parts of society because we're on different digital platforms or blockchains.
Yeah, and
I'm not sure that hasn't already happened, Markus.
I know,
there's
but
also
perhaps
an
we should
issue
lean
of
against that.
small versus big payments. For the payment system like India, for example, with just a phone number, that's enough data for you to enter the Aadhaar identity system and get UPI payments. And in other countries, privacy can be maintained by giving opportunities to make very small payments without giving up a lot of data. And then if you're going to make larger payments, you have to give up more and more data. That's how China's ECNY is being developed, if you trust the way that it's being described.
I think, Markus, it's even more basic than how you described it. I would go back to the whole idea of a digital ID system. If you like, a well-functioning digital ID system is a precondition for even the kind of, the Indian UPI system or, the PICs, something which can actually allow you to digitize the current two-tier bank-based system. And certainly in the US and in the other case I know well is the UK. There is this even for the notion of a digital ID, I think there is an aversion to actually having it, if you like, sort of systematized. I think there are good reasons for that, and as David said, these things do vary across countries. There are some countries where which have more of a tradition of the family register. You go back and you can actually have on paper form the much more complete set of ID information, which if you then digitize, makes it much more amenable to be used as a basis for these CBDC systems. But as you know, Markus, there are ways of constructing the CBDC in a way that masks some of the sensitive information. You can, for example, the way that the ECB has described it in one of their ideas is to have a privacy commissioner, a data privacy commissioner, who would actually have the real information, the real name information of someone who is participating in the payment system. But the ECB would not have the real name, but would simply have the ID, some kind of one-to-one mapping with the real name. But there's no way of getting at the address or the name or the other personal information. And then the idea that was floated in this paper some time ago was to have a quota, give a quota to each individual, in the system, which they can use to make payments anonymously. So what you would do is you would use some of the credit that is granted to you up to some limit to make payments anonymously. Maybe you want to, make a small purchase. Maybe you want to, buy a surprise birthday present. So the kind of purchases where you would normally use cash, you would use up some of this quota, and then the commissioner would then sort of allow you to give you a credit for you to make that payment anonymously. Now, of course, that's a very elaborate system, yes. And it is somewhat unwieldy in some ways. But the fact that these ideas are being floated, I think, gives you a sense that privacy is an incredibly important objective when central banks think about CBDCs. People are under no illusions that having a sort of register with everything, with all the information on what brand of toothpaste you buy, what you've bought on which day. I think that kind of information is not something that you want to be responsible for. And so this jigsaw puzzle principle that I referred to earlier, I think is a very important approach that we need to keep in mind. And with sufficient ingenuity, and we have the technology with public key cryptography, that we can go some way towards mitigating some of those risks.
So I would like to spend the remaining time on international dimension of CBDC. I mean, Hyun, you elaborate on that as well, but going perhaps beyond CBDC, and I would like to understand, what do you think all this opening the international currencies and other currencies. What is the implications for the dominance of the dollar? What's your take on that? What do you think about, are runs on currencies more likely? Because I can much more easily substitute in some other CBDC. Right now, it's more difficult. I have to go to bank. If I want to transfer a huge amount of money, it's not so easy. But, you know, is there more competition across the existing national currencies? And hence, inflating your way out is not so easy anymore, because I'm just shifting my money out of the euro in some other currency, or the dollar, which is suffering not from such a high inflation. And what about capital controls? Can I enforce the capital controls the same way I can enforce it now? I can just do it through some other currencies, Bitcoin or whatever. What are the divisions you have? How will this destabilize the whole international financial architecture? Anybody wants to jump in first? Darrell?
Can I try? So first, when I have conversations with people about this, I find there's a confusion between cross-border payments with CBDCs of the type that Hyun described, using a bridge or other infrastructure to leap from one country to another, versus the idea of, let's call it dollarization. The idea that, let's say, China's new central bank digital currency, ECNY, could yuanize other countries, well, that's limited to the extent that the People's Bank of China wants to give accounts to customers in other countries. It says it won't do that. I certainly believe that the United States central bank, most of the European central banks, almost no responsible large central banks are going to go out and hurt monetary sovereignty in other countries by providing a wide range of accounts to people in other countries. It's just not likely. So where is this competition for dominance of currencies going to come from in the digital space? I would argue that if it arises, it's going to be in something like stablecoins. If suppose, for example, that the United States completes its vision for how to regulate stablecoins, and they say, oh, let's say USDC, which is one of the large US stablecoins, that's going to have to be compliant. It's now regulated. And then I'm a CFO in Paris and I'm making cross-border payments. I'm going to say, well, I really like that stablecoin. It jumps over all of the correspondent banking fees and delays. I'll start using that, and I think it's a prospect that that digital currencies that are private will start to be used more and more. If they're well regulated, why not? Now the issue of dollarization comes alive, because if anybody in the world can hold a US dollar stablecoin relatively anonymously and pay each other, as you know, in Argentina, people often pay for almost anything with paper US dollars. Wouldn't it be a lot easier to pay off your mobile phone with USDC or another stablecoin? That's where I think you're going to start to see more competition. And will regulators in the US say, no, we don't want to interfere? Maybe not if official sector in another country says, oh yeah, we want to internationalize our currency, we're going to allow it. You have regional competition between stablecoins as proxies for currency competition. For the time being, I don't think the dollar dominance is really that threatened, especially by China, because of its capital controls, also because of the trust in the rule of law and US bond markets being so deep. But over time, you know, there'll be geostrategic considerations will start to come to bear, and there could be some degree of competition. And I think private digital currencies might be, or other fintech entrants to cross-border payments, and maybe start to become more important. By the way, China has introduced a cross-border renminbi stablecoin called CNHC. Well, it's about to get introduced.
I agree with that.
My earlier question, shouldn't you issue such a stable coin? You know, it's just free money on the street to be picked up. And then later on, it will be a dominant global currency. Anyway, Hyun, you wanted to say something?
Yeah. I just want to support what Darrell just said. I think it's very important to draw a distinction between CBDC and $100 bills that David showed circulating in the black market in briefcases. With a CBDC, it's a ledger entry. It's a ledger entry in the central bank that has issued the CBDC. So for someone to use the CBDC outside that jurisdiction, the issuing central bank has to allow that to happen. And so, I mean, there are cases where the central bank might allow that. For example, if you are traveling in Thailand or in Korea, you can actually use, Alipay through one of the correspondent banks, and that's a case where, that's not a CBDC, but it's one example of where, if you have visitors who are using, Alipay or WeChat Pay outside China, you want the department store or, the particular merchant in that jurisdiction, the ability to accept those payments. Now, you could envisage that, there would be a demand for, use of the ECNY outside China, perhaps for the visitors who are outside China. Now, so that's a instance where, there may be a demand, but in the end, the central bank has to allow that to happen, because it has to be a ledger entry that has to be, recorded that says, we have, paid so-and-so, and debit this account and credit this account. So it's not like, dollar bills floating around in the black market. And I fully also agree with Darrell that it's much more likely that it's going to be a private stable coin that will actually be the encroaching element in another country, because all you need for the onboarding of an account would be either the telecoms operator or the chat app for you to be able to use such a service. And I think this is exactly the reason why the idea of the global stable coin caused such a big discussion a couple of years back. Now, I think the issue of the role of the dollar, I think it's very important to, my view of this is that a currency merely by being in digital form, that's not going to, as it were, sort of make it a global currency. There has to be the underlying economic need for the transactions, so either for trade or for financial transactions, whether it's in digital form, whether it's a CBDC or a bank transfer or cash, that really is secondary to whether there is the underlying demand for the economic transactions. And I think history teaches us that you need those kinds of underlying financial transactions demand there for a currency to be used across borders. Just by throwing a switch and making it digital, that's not going to make a currency a global currency.
David, do you have a take as well?
I think it's a little ironic that the stable coins at this point are about 99% denominated in US dollars. It certainly doesn't have to be that way, but there seems to be a huge latent demand for dollar stable coins. So if anything, the hegemony of the dollar may be reinforced rather than undermined by this, and we'll see how things evolve over decades and centuries, but I don't think people should be losing sleep at the moment. It's really the seigniorage revenue more than the status as the reserve currency that I think is more at risk in the short term.
So if I may summarize, is this correct that you're saying in the olden days when the Fed was printing cash in order for some illegal transactions in the suitcases you had, now it's a stablecoin issuer who is issuing some stable coins who gets essentially a seigniorage. That's a big difference. Otherwise, it will stay the dollar, but just the question is who gets a seigniorage.
I think that's pretty well said, yeah.
Then I would like to, in connection to that, there's always this argument that the US was weaponizing the US dollar, in terms of the SWIFT system and all this, excluding certain countries or excluding and trying to use it as geopolitical instrument. Do you think that the whole development of these different international currencies will make it more difficult to weaponize the dollar? On the one hand, we say the dollar becomes through the stable coins even more prominent. On the other hand, there might be a lot of loopholes where you can actually, for other countries to get around it using other digital currencies. Do you have any take on the weaponization of the dollar? Is a big push towards alternative payment systems?
Yeah, I think, the Chinese and the Russians are both trying to work against this, but it's really Ripple and Bitcoin that have been much more successful. And, there's a lot of Bitcoin capital flight out of China into US real estate. Ripple, the US government is now coming after them rather belatedly, realizing that it's not just Ripple, but the entire set of actors who are trying to compete with the SWIFT network are going to make it much harder to use that as a bottleneck choke point on the international financial system. And I think the horse is out of the barn at this point, that the ability of the US to weaponize the dollar in the way that you're saying, the sun is setting on that, in real time.
I think, Marcus, rather than the dollar, I think the role that Bitcoin has played, I think in highlighting these issues to do with money laundering and scams and thefts and so on, I think, and ransomware attacks, I think that's really been the big development. David mentioned the spate of ransomware attacks last year. Of course, you can have ransomware even without Bitcoin, but I think it certainly is a hell of a lot easier if you have something that cannot be traced. And this goes back to our earlier discussion about points of contact between the crypto world and the conventional financial system, where I think of course that whole ecosystem will do what it does, but to the extent that it actually has points of contact with the banking system, with the conventional financial system, I think that's where we need to think about ways of bringing in consistent regulation, much more so that than perhaps has been that we've been able to do so far. And the whole framework towards crypto regulation, I think this is certainly very much on the radar, among all the official sector players, and also in Basel with all the various groupings here.
So do you think it's very important that there's a global coordination? So if certain countries would break away and open up the traditional banking system to the crypto space through whatever measures they have, like James Angel said, like he was asking what's the implication of certain countries are making Bitcoin their legal tender, things like that. So El Salvador, for example. Would you say that there needs to be global coordination across all the countries to be successful in this? Or is it okay if the key countries say, okay, we don't allow some connection between the crypto space and the official banking sector? That would be enough.
Yeah, I think coordination is certainly important, and I think we could even say essential. It doesn't mean that we all have to land with exactly the same regulations, but there certainly would need to be broad consistency across countries. And if we think about the main financial centers, if we think about the largest markets themselves, we already have a multilateral approach to all of these things. There is the FSB here in Basel. There is FATF, which has been traditionally taking the lead on these money laundering, anti-money laundering type initiatives. And I think the report that the President's Working Group put out recently, last November, I think is a very, very important step in that regard. So it's I think the approach should be that we need to take a very high level view of this. The objective is not to shut down the activity. The objective is very much to make sure that whenever there is a point of contact, that's something that we have to be very consistent in approaching in terms of regulation. And I think the PW report did actually highlight two of the most important things, which is who can issue stable coins and how will the wallets of whichever form be regulated.
Okay, thanks a lot. So I'm getting the signs that we're running out of time. So I would like to use the last minute to thank you all. So all of you who are still here with us, lots of participants in the audience. and in particular the panel participants, David, Darrell, and Hyun, for covering a lot of ground, going beyond CBDC and many things. But I think in order to understand the new world of digital money, we have to really cover the big picture, and we did so. And I'm very grateful for all three of you for doing so, and hope to have more ongoing discussions on these topics as we develop more and learn more in this very exciting research area. Thanks again.
Thank you,
Thank you,
Markus.
Markus.
See you soon. Bye-bye.
Thanks, Markus. Thanks, everyone.